Most people know that investing is important, but you realize that lots of people avoid investing. Not good enough at analyzing and choosing stocks or investments. Well, there's a solution to that worry, which is just invest. You might have heard words like mutual funds, hedge funds, index funds, ETF, and all other funds. So in this about what is a fund, the types of funds, how does the fund work, and how to choose a fund for your investment then. Section 1. What is a fund? Even though a mutual fund, index fund, ETF, hedge fund, and are different, they all have the same concept, which is a fund. Imagine you're hungry now and want to eat some snacks. There's different types of snacks available, like cookies, candies, chips, and crackers, with each costing $2. But $2, which is good enough to buy one snack. You also worry whether if you buy just one snack, will it taste good? If it tastes wasted, your only money. So you ask 3 friends to put in $2 each. Now you have $8, enough to buy. You and your friends can share and enjoy everything together. If the cookies taste bad, no problem. There are 3 other snacks. That's the simple logic of funds. A fund is like a pool of money, where your money and other investors' money are collected, and a variety of assets like stocks, bonds, cryptocurrency, and more. For example, let's say there's a fund company called We Fund has $50 and decides to invest $10 each in 5 companies: Apple, Microsoft, Google, and Nvidia. So each company then makes up 20% of the total portfolio. Now let's say you decide to invest in We Fund. Your $5 gives you a fraction of the fund, which means your money is spread across all 5 stocks. It means that your $1 of your $5 is invested in each of the companies. So by just buying one fund, you can own 5 companies. Sounds good, right? Of course, in reality, most funds hold hundreds to even thousands of stocks. For example, $1 into the Vanguard's VTI ETF, it means with just one transaction, your $1 can already 3,600 stocks. So instead of buying stocks one by one, a fund can offer you like a big bag that's full of stocks. Some types of funds are managed by professional investors who handle everything for you. But of course, it's not free, and you need to pay a figure. But the good thing is, you don't need to do deep research and keep watching the stocks because someone is doing it for you. But wait, did our funds have professional investors? Does that mean other types don't? Well, that's what we'll talk about in the next section. Types of funds. As I mentioned earlier, you've probably heard of terms like mutual funds, ETFs, index funds, hedge funds, but what exactly are they and how do they differ? Let's break it down. The first type is mutual funds. A mutual fund pools investors and is managed by a professional fund manager. The manager will decide how to invest the money by buying and selling stocks, assets to achieve the fund's goals. Mutual funds can be actively managed or passively managed. If mutual funds are passively, often called index mutual funds, which we'll explain in the next section. If the mutual fund is actively managed, then this means that the fund monitors investments daily, aiming to maximize returns or minimize losses. And of course, this daily monitor they charge annual fees called expense ratios, which range from 0.5% to 1.5% of your investment. Example, if you invest $1,000 in a mutual fund with a 1% expense ratio, you'll pay $10 per year. Pay the 1% expense ratio every year, even though your investment grows or even drops. However, mutual trade on stock exchanges like individual stocks. You can only buy or sell mutual funds after the stock market closes, based on the day's closing value or the last value before the stock market closes, which is called the net asset value, AV. And also, mutual funds often have a minimum investment requirement, which can vary. For example, most mutual funds might require around $500 to $5,000 to invest. And that's why actively managed mutual funds are really friendly to beginners. Some of the famous actively managed mutual funds are Vanguard's VP Max, Fidelity's FBG, T. Rowe's TRBCX, and much more. Now, the second type is index funds. If most mutual funds are actively managed or passively managed, index funds are designed to match the performance of a specific index. So what is an index? It's a list or group of investments, usually based on their size, sector, or other criteria. For example, the most, which is the S&P 500 index, includes the 500 largest companies listed on U.S. stock markets, like Amazon. If you invest in an S&P 500 index fund, like Vanguard's VFIAX, your money will be from all 500 companies in the index. The index fund manager doesn't care whether the companies are good or not. In the S&P 500 index, then they'll just buy the stocks. If, let's say, a company named ABC Company, which is listed 100th biggest company in the S&P 500, then the index fund will buy all companies in S&P 500 list in company stock. If the ABC Company got replaced by DEF Company and it went down to 501st place, fund will just sell the ABC Company and use the money to buy DEF Company. So why do people buy index funds? Because understand. For example, the S&P 500 index represents 80% of the total U.S. stock market value. Believe that the U.S. economy will continue to grow, you might invest in an S&P 500 index fund. Or, if you think companies will perform well, you might choose a NASDAQ 100 index fund, which focuses heavily on technology companies. These funds are passively managed, which means the fund managers are not watching the market every time. Their fees are usually variously under 0.5%, which is great if you're on a budget. Index funds can come in two styles, as mutual funds, or if the index fund is in a mutual fund style, it's just the same as mutual funds, which can only be traded after the stock market. The difference is only the index mutual fund is passively managed and just follow the index list. Famous examples of funds like Vanguard's VFIAX, Fidelity's FNILX, Schwab's SWPPX, and much, much more. ETF style. Well, we'll talk about it in the next part. The third type is ETFs, or exchange-traded funds. ETF is a type of fund that can be bought and sold on the stock exchange during trading hours, just like individual stocks. Sell ETFs anytime using a stock trading app, and most ETFs have minimum investment requirements, as low as $1, depending on your stock trading app and broker. This makes ETFs very beginner-friendly and easy to use. ETFs, actively managed and passively managed. However, most ETFs are passively managed, like index funds that follow us based on specific categories or performance. That's why, when people talk about ETFs, they're usually referring to ones. Some examples of passively managed ETFs include Vanguard's VOO, which follows the S&P 500. If you want to invest in the S&P 500, you can buy Vanguard's VOO. Don't like VOO? No problem. There are plenty that also follow the S&P 500. You can also invest in Invesco's QQQ, which tracks the NASDAQ 100 index, technology companies, or Vanguard's VT, which invests in both U.S. and international stocks. There are even ETF SMH, which focuses solely on semiconductor companies like TSMC and NVIDIA. Some ETFs even invest in like Bitcoin. Interesting, right? As mentioned earlier, there are also actively managed ETFs, such as ARK's ARK, FTSE, and TRAO's TCHP. And you might notice the expense ratio is higher because it's actively managed. The fourth type is hedge funds. A hedge fund is just like a mutual fund, but for the ultra-wealthy and experienced investors. Funds might require a minimum investment of $500 to $5,000. Then hedge funds often have minimums from $100 to several millions of dollars. Not only that, hedge funds are very aggressive. They take bigger risks in hopes of. This can include investing in complex investment strategies, short-selling stocks, or even betting against the market. Hedge funds are usually actively managed. Some examples of hedge funds are Bridgewater Associates, Citadel, and Millennium. Well, those are the explanations of the four common types of investment funds. To wrap up, here's a summary table comparing these funds. Screenshot. Now, let's continue to the next section. Section 3. Which fund is the best? After learning about the funds, you're probably wondering which fund is right for you. Which one can make the most money? Let's find out. For convenience, if you want something flexible and easy to trade, ETFs might be your best choice. You can buy and sell them hours, just like individual stocks using a trading app. If you're looking for an easy-to-use trading app, Moomoo is a great option. Online platform where you can trade stocks and ETFs with low fees. Plus, if you sign up through the link below, you can get up to 15 free deposit and earn an 8.1% APY on your idle cash. On the other hand, mutual funds, including its, can also be traded using stock trading apps, but they are less flexible since they're only priced at the end of the trading day, trade instantly like ETFs. But if you're not a fan of seeing your investment go up and down throughout the day, mutual funds might. Hedge funds, meanwhile, are for ultra-wealthy, experienced investors and are not publicly traded like ETFs and mutual funds. Next, let's discuss minimum investment and expense ratio. If you're starting small, ETFs are perfect as they have no requirements and the lowest expense ratios. Mutual funds are good too, but often come with higher minimums and expense ratios. Unless you have thousands or millions to invest, they're probably out of reach. Finally, let's talk about performance. You might think actively managed funds or hedge funds deliver the best returns, right? Well, in some countries, it might be right. Yes, the data shows that passively managed index funds, or ETFs, often outperform many actively managed mutual funds in the long term. Wait, what? That sounds illogical, right? How can simply following a list of indexes beat managers? Well, before we continue, it doesn't mean that passive index funds, or ETFs, always beat the actively managed mutual funds. As you can see here, some actively managed funds still beat the passive index funds. But there's also a sick of actively managed funds that underperform the passive index funds. So why does this happen? Well, the reason is that performing better than everyone else in the investment world is extremely hard. Actively managed mutual funds and hedge indeed outperform index funds and ETFs, but most of them struggle to do so consistently. On the other hand, index funds and ETFs aim to grow slowly but steadily over time. And also, the higher expense ratios poorly managed mutual funds and hedge funds, they can add up over time and reduce your overall returns, especially if they're performing. Meanwhile, passively managed index funds and ETFs, with their super low expense ratios, have minimal impact on your investment. So, actively managed funds can offer higher returns, but with higher risk, while passively managed funds offer lower returns risk. So, in conclusion, you now know what funds are, how they work, the different types available, and how to choose the right investment. Funds are a great option for beginners and experienced investors alike because they simplify investing, option, and can be used to reach your financial goals. And remember, every investment has risks. Always do thorough reading any investment, whether in mutual funds, index funds, ETFs, or hedge funds. If you want me to make other videos explaining, please like and subscribe. Thanks for watching.